Good afternoon, welcome to Market Wrap number 188. Stuart Williamson here at the helm in Singapore once more. This week we're going to look at revised 2024 house price forecasts, look at market sentiment and look at positivity. Because basically here in 2024 what we've seen so far this year is complete sea change of market sentiment. Gone is the doom and gloom of high interest rates, or they're 8%, could they get worse? And the negativity on growth. A much more positive outlook, people coming in and saying, let's buy, let's get going. Now, why is that? In October, financial markets were pricing in a single interest rate cut of 0.25% by the end of 2024. At the end of last week, they were expecting 5%. The main reason for this is the changing outlook in inflation, and it's falling faster than expected. As a result, all mortgage lenders have gone out and dropped their rates fairly significantly in recent weeks, partly to win business in a low volume market as well. Now you can get a 5-year fix starting with a 3, which has been made possible after 5-year swap rates fell a full percentage point over the final quarter of 2023. Now, December inflation figures are just out today, and that will temper some enthusiasm. But when momentum has started, and it certainly has, and you've got the mortgage rates being cut, you've got people out there reporting that they believe rates will go up, it's going to be difficult to stop, like it was difficult to stop negative sentiment. Inflation outlook is not clear, according to Neil Burrell, Chief Investment Officer at Premier Miton Investors. He raised doubts over the direction of the travel inflation, which is basically that inflation had jumped back up again to close to 4% in December from 3% where it was. It's still below the forecast of the Bank of England, but nevertheless, the bank will have to be considerate of, is it going to create a slump on the one side, a recession, or does it want to stimulate the economy? And he seems to think that most economic data that's coming back in is looking positive, and we should have cuts, but all eyes are on it really. What are Savills saying, for example, as far as UK sales expectations? In their most recent report this week, they now expect UK mainstream prices to rise by 3% in 2024, which compares to a decline of 4% predicted just 4 months ago, with low-level single-digit growth in subsequent years. They expect cumulative growth of 20.5% in the 5 years to 2028, and this is across the board, taking into account the falls that are expected in the south and the south coast. Also, data from Halifax and Nationwide certainly suggests that a corner's being turned, while the former reported a 1.6% to 1.7% increase in 2023, and the latter posted a fall of 1.8%. That compares to a 5% decline they were saying 4 months ago. UK housing transactions are a fifth below their 5-year average, but Savills are waiting for a clear pattern to emerge before they say anything. And this is the pattern you can see in this graph. It's very clear we have turned the corner, and now is the time to be jumping in. As a result of stronger demand, the number of mortgage approvals was 10% higher in November than previous year. They expect a double-digit percentage increase in sales volumes this year. Remember what JP Morgan said, buy when other people are selling, sell when other people are buying. Now is the time to be buying when people are worrying about what the future holds. The forecast is slightly lower for growth in mainstream London market, plus 2%, as there are continued affordability constraints in the capital, and this means lower value areas of the country are likely to outperform. What does that mean in King's English? It means that the Midlands and the North will go up because they're lower value. In the prime country house market, they now expect a narrow decline this year, less 2%, as the market comes down from the highs of the pandemic in recent years. Realistic asking prices will remain important as the race for space is no longer driving demand. And it's not. Race for space is over, and the beneficiaries are the North, where work from home is possible still. They expect a more positive growth from London markets, PCL, Prime Central London and Prime Outer London, to underperform wider UK market this year. That means the South and the South East will underperform the North and the Midlands. Given that prices are still 17% lower in London than the last peak of 2015, they believe growth will kick in from next year. So next year, starting, London looks like it'll be a buying opportunity. You then got to look at what are the risks to the current momentum. It all depends really a lot on the general election. There's a risk that Rishi Sunak can't fully control the timing if ideological splits within his own party on the issue of immigration grow wider, which adds to an element of uncertainty. Speculation over the stability of the government is not good for sentiment in the housing market, and we saw that under Theresa May in 2019. The ongoing conflict in the Red Sea and the threat it potentially poses to high UK inflation is another risk on the horizon. But on the plus side, activity could and will, I think, be boosted further by pre-election giveaways in the March budget. They're talking about cutting inheritance tax, cutting stamp duty, as well as helps for first-time buyers, and then longer fixed-term mortgages. That's a big buzz this week. Smaller deposits, no need to have so much, and a revived Help to Buy scheme. A Labour victory appears the most likely outcome at this stage, and while it has ruled out introducing rent controls, thank the Lord, look what's happened in Scotland, and other wealth taxes, other measures could dampen demand in property markets. These proposals include overhauling the non-dom tax regime, increasing the 2% stamp duty surcharge for overseas buyers, shock horror, that's us, adding VAT to school fees, and changing IHT rules. What about the UK rental market forecast? That's crucial for us as landlords. A lot of landlords have left the sector in the recent years due to extra red tape, which puts strong upwards pressure on rental values. However, supply is now recovering as demand is gradually being absorbed and more sellers have become landlords in a sales market where price growth has been minimal. So don't sell, become a landlord. That's what's happening. There's more people coming back into the market. New listings in prime central London and prime outer London were only 7% below the 5-year average in December, Rightmove data shows. That's brilliant. We've not altered our rental forecast dramatically, they say, from October, and forecast a 5.5% rental value growth in London. It'd be lower than previous 2023 of 8%. Rental value growth will be stronger in the lower value markets. And based at Savills are a big property, big London orientated company. That's a lot they talk about. And this is because the supply and demand distortions are greater. The property owners are typically more discretionary in higher value markets and have been able to let while price growth has been flat. There were 4.3 new prospective tenants for every rental listing below £1,000 per week in London in the final quarter of 2023. Knight Frank data shows. Above £1,000 a week, the figure was 2.7. That said, rising mortgage costs, taxes and red tape, including the Renters Reform Bill, should maintain upward pressure on rents this year by keeping supply in check. And for context, our forecast of 5.5% for London this year was last beaten in 2011. Across the UK, annual growth was 6.2% in November, according to the Office of National Statistics, the highest rate since records began, as the wider UK rental market grapples with the same demand-supply issues. As these reduce gradually, we expect the UK rental market, Savills say, to decline slightly to 5%. That's rental inflation, with a slightly higher figure of 6% in London, where demand is strongest. So, there we have it. Property prices to improve this year. Mortgage costs to reduce this year. Perhaps not as quick as some people are hoping, but they'll still fall. And finally, rentals still going up. So if we're buying today and the mortgage is 5%, in 4 years' time, if it's 5% increase in rents, those rents will have gone up by 20%, whereas your mortgage won't have. Inflation will have eroded it. The rate will have fallen. So it's a great buying opportunity now. Last week I talked about buy high yield investments such as social housing, supported housing, big houses of multiple occupancy, those sort of things. That's still current, and I would be looking at that. Add value by buying PDRs. Look at those sorts of things. But at the same time, we can still make good money on a vanilla if you buy in the right place at the right time. Thank you very much. That's it for this week. Market wrap number 188. If you would like more information, please do drop us a line and let us know. Thank you very much for listening. All the best, and look forward to speaking to you late in January. Ta-da.